Level 1, no credit. You apply for your first credit card. You fill out the application. Income, address, social security number, everything looks correct. A few seconds later, you get the result. Denied. Not because you did something wrong, but because you don't exist in the system. You have no credit history, no accounts, no record of borrowing or repaying money. To lenders, that means one thing: unknown. Your credit score doesn't exist yet. There is nothing to calculate. You are not considered risky. You are simply unproven. That creates a problem. Banks don't lend based on potential. They lend based on history, and you don't have one. So your options are limited. You may need a secured credit card where you deposit your own money as collateral, or a cosigner, someone who already has credit and is willing to take the risk for you. At this level, the goal is not access, it is creation. You need to build a record. One account, one payment, 1 month at a time. Because every payment you make is tracked, every balance is reported, and over time, that information becomes your credit profile. Right now, you are invisible, but the moment your first account is open, that changes. You enter the system, and once you're in, every action starts to matter. Level 2, very poor. You check your credit score. It's in the low 500s. Now you exist in the system, but not in a good way. Your credit report shows missed payments, high balances, or accounts in collections. Lenders don't see potential, they see risk. Applications get denied more often than approved, and when you do get approved, the terms are expensive. High interest rates, low credit limits, and sometimes security deposits become normal. A credit card might come with a 25% interest rate. A loan, if you qualify, is priced for risk. The system is not working against you. It is reacting to your history. Payment history is the biggest factor in your score, and missed payments stay on your report for years. High credit utilization also matters. If your balances are close to your limits, your score drops further. At this level, the focus is not growth. It is correction. You start paying everything on time. You reduce balances. You stop adding new debt. Progress is slow, but it is measurable. Every on-time payment helps. Every reduced balance improves your profile. Because the system is always updating, consistent behavior begins to replace past mistakes. Your score starts to rise, not quickly, but steadily. And once it moves out of this range, your situation begins to change. You are no longer in damage control. You are rebuilding. Level 3, poor. You check your credit score again. It's now above 580. That number may not seem high, but it represents progress. You are no longer in the lowest tier. Lenders still see risk, but not the highest level of it. Some applications begin to get approved, but with limitations. Credit cards may come with low limits. Loans, if approved, still carry higher interest rates than average. You have access, but not favorable terms. Your credit report looks different now. Fewer missed payments, lower balances, more consistent activity. The focus at this level is rebuilding. You make every payment on time, not most, every single one. Payment history continues to be the most important factor in your score. You also work on reducing your credit utilization. Keeping balances well below your limits, ideally under 30%, begins to improve how lenders evaluate you. Progress still feels slow because negative marks from the past are still there. Late payments and collections don't disappear immediately. They fade over time as new positive behavior replaces them. That is the key shift. You are no longer reacting to past mistakes. You are actively building a better profile. Consistency becomes your advantage. And as your score continues to improve, lenders begin to see something different, not risk, reliability. That is when you move into the next level. Level 4, fair. You check your credit score again. It's now above 620. For the first time, lenders begin to see you as a moderate risk instead of a high one. Applications that were previously denied start getting approved. You may qualify for standard credit cards, auto loans, or personal loans. But the terms are still not ideal. Interest rates remain higher than average, and credit limits are still relatively conservative. Your credit profile is improving. Payment history is now mostly consistent, and your balances are lower. You are no longer fixing major damage. You are maintaining stability. At this level, consistency matters more than anything else. You continue making every payment on time. You keep your credit utilization low, ideally well below 30%. You avoid unnecessary applications that could temporarily lower your score. Lenders are beginning to trust you, but that trust is still conditional. One missed payment or a spike in your balances can slow your progress. That is why discipline becomes important. You are no longer reacting to problems, you are preventing them. Because at this level, your behavior is shaping your future access to credit. And as your score continues to rise, the system starts responding differently. Better approvals, better limits, better terms. You move from being acceptable to being reliable. Level 5, good. You check your credit score again. It's now above 670. This is where lenders begin to see you as a reliable borrower. Most credit applications are approved. Credit cards, auto loans, and even mortgages become accessible with reasonable terms. Interest rates are lower than before, and your credit limits increase. Your credit profile shows consistency, on-time payments, controlled balances, and a longer history of responsible use. At this level, the focus shifts from rebuilding to optimizing. You manage your credit utilization more carefully, keeping balances low relative to your limits. You avoid carrying unnecessary debt, especially on high-interest accounts. you begin to understand how different factors affect your score. Payment history, credit utilization, length of credit history, new inquiries. You make decisions with those factors in mind, not reacting, but planning. You may start using rewards credit cards, earning points or cash back while paying balances in full to avoid interest. Your credit is no longer holding you back. It is helping you. Lower interest rates reduce borrowing costs. Higher limits improve flexibility, because at this level, access is no longer the problem. Efficiency is. And as your score continues to improve, the advantages become more noticeable. You move from being reliable to being preferred. Level 6, very good. You check your credit score again. It's now above 740. At this level, lenders see you as a low-risk borrower. Approvals become easier and faster. You qualify for better credit cards, higher limits, and significantly lower interest rates. Mortgage and auto loan offers come with more favorable terms compared to most borrowers. Your credit profile shows strong consistency, a long history of on-time payments, low utilization, and stable accounts. At this level, credit becomes a tool. You use it intentionally. You choose cards with specific benefits, such as cashback or travel rewards. You may take advantage of promotional offers like 0% APR periods, using them strategically without carrying long-term debt. You understand how to maintain your score. You keep balances low, often well below 10% of your available credit. You avoid unnecessary hard inquiries. You keep older accounts open to preserve your credit history. Lenders compete for your business because you represent predictable repayment. At this level, the focus is not just maintaining a good score, it is leveraging it, using access to reduce costs, improve flexibility, and take advantage of better financial opportunities. And as your score continues to rise, you move into the highest tier, where credit is no longer a limitation at all, it becomes full control. Level 7, excellent. You check your credit score again. It's now above 800. This is the highest tier. At this level, lenders see you as an ideal borrower. Your credit profile shows a long history of on-time payments, very low utilization, and stable accounts over time. Approvals are no longer a concern. You qualify for the best available terms. Credit cards come with high limits and premium benefits. Loans are offered at the lowest interest rates available to consumers. Your financial profile signals consistency and reliability. Because of that, lenders compete for your business. Pre-approved offers become common. Credit increases happen with little effort. Applications are processed quickly and often approved without complications. At this level, your focus is maintaining control. You continue doing what brought you here: on-time payments, low balances, and careful management of your accounts. You avoid unnecessary risk. You don't open accounts without a clear reason. You don't carry balances that generate interest. Your credit score becomes stable. Small changes no longer move it significantly because your history is strong enough to absorb minor fluctuations. At this level, credit is no longer something you worry about. It is something you manage. And once you reach this point, something shifts again. The score itself becomes less important because the real advantage is not the number, it is how you use it. Level 8, Strategic Credit User. You stop checking your credit score, not because it doesn't matter, but because you already understand how it works. At this level, the number is no longer the goal. It is the result of your behavior. You choose when to apply, not out of need, but based on timing. You understand how inquiries affect your profile and space them out accordingly. You manage utilization with precision. Balances are kept low, not just overall, but on each account. You know that even small changes can influence how lenders evaluate you. You use credit cards for rewards, not for borrowing. Cashback, travel points, sign-up bonuses, all optimized, while paying balances in full to avoid interest. You may use promotional offers strategically, 0% APR periods to manage cash flow, balance transfers when they make sense. You understand the cost of debt, and you avoid it unless it serves a purpose. At this level, credit is not something you rely on. It is something you control. You understand how lenders evaluate risk, how scores are calculated, and how behavior translates into access. Because the system is no longer unclear, it is predictable. And once you understand that, credit stops being a limitation. It becomes a tool, one you use when it benefits you and ignore when it doesn't.